Listen, I am going to tell you one thing straight away that most financial channels don't say out loud. If you keep watching gold climb above $5,000 an ounce and think it will cost tens of thousands of dollars just to enter the market, you are selling an untrue story. Now, in April 2026, you can buy legal government-backed gold bars without a decent secondhand iPad. Most people don't know that option exists. Here is what happened in 2025. Global gold investment demand hit a record high of 2175 tons. In addition, the central bank has accumulated 863 tons. Retail investors alone have poured $154 billion into physical gold bars and coins. No one really talks about it, but most of the demand comes from people who start with small coins. Wall Street rarely mentions entry-level options because they pay less commission. Today, we'll analyze whether grades are a smart way to build real wealth or simply overpay for convenience. Believe me, the answer is far more complicated than gold traders tell you. We sat here in April 2026 with spot gold prices hovering around $4,600 an ounce. That is not bad news at all for anyone who believes gold is a store of value. This is actually incredible news, but here is what financial channels want to tell you directly. And that is the cruel part. With a dealer premium, the American Golden Eagle sells for $4,800 to $5,100 an ounce. That is basically a down payment on used cars. For most people, this is no longer an investment decision. It is a big life decision that most people can't make. Think about your actual place in life now. If you are in your 50s, maybe retired or semi-retired, you've been told for years that you should diversify into hard assets. When the stock market gets weird, gold should protect you. But when you scrape together $5,000 for a coin, you are asking yourself some questions that everyone feels chilly. Did I really do that? Is this the right move? Should I wait to see if gold pulls back? This is where psychological barriers hit 99% of retail investors. The entry point feels too high and the sense of commitment is too strong. What do? Nothing. They paid in cash. They remain overvalued index funds. They watched gold climb from $2,000 an ounce to $5,000, but did nothing. But what if there is a completely different path you haven't considered? What if you can buy physical gold, real government cast, vault quality gold for less than $550 a piece? That is gold. It sat there, waiting for someone smart enough to actually use it. Let me start with technology, but I keep it simple because it matters. Scores are not a crude substitute for real gold. They're not digital, they're not paper, they're not a fund where you trust companies to manage your money. They are physical gold coins minted by the same government mint that makes whole ounce coins, but in smaller denominations. The most common fraction sizes on the market are half-ounce coins, quarter-ounce coins, 10-ounce coins, and 20-ounce coins. If you want to play micro-accumulation, you can even make it smaller with a gram of sticks. But I'll tell you right away why this is usually not the best choice. An ounce of gold is equivalent to 31.1 grams, which needs to be remembered. When you buy a 10-ounce coin, you hold about 3.11 grams of pure gold bars, not gilded or powdered, but real gold. One 10th-ounce American Golden Eagle is exactly the same purity as the full-ounce version. 91.67%, 22K gold, supported by the US government. It even has a legal tender face value of $5. So if things get really weird, technically you can spend it, though no one will, because the metal is worth far more than $5. Canadian maple leaves are 99.99% pure, as is the Austrian Philharmonic. None of this is fakes or compromises. They are real deals, but in smaller forms. Every major sovereign mint in the world produces versions, and that may not be a marketing point of view when the entire precious metal infrastructure around the world offers these smaller sizes. Perhaps they are the truly legitimate financial instruments that people really need. Let's talk about real money, and let me show you how much you actually paid in April 2026. A 10th ounce of American Golden Eagle coins from traders such as JM, Abmex, or SD bars cost about $530 to $553 each, including a so-called premium, a rise in the original spot price of gold. We'll discuss why this premium exists later. Meanwhile, a full ounce of American Golden Eagle sells for $4,800 to $5,100. Now let's do the math that really matters. Coins sell for $4,900 an ounce. A 10-ounce coin costs $530. What tenth of an ounce of coin is an ounce? Here is 10 pence. So 10 pence cost you $5,300. That is $400 more than an ounce of coins. The difference of $400 is a premium penalty for buying smaller currencies, which is the price you pay for the flexibility and ease of use of fraction coins. But that is where the idea gets interesting. Can you save $4,900 tomorrow and buy an ounce of coins now? Or are you thinking about finding $530 next month? Because this is where fraction coins become dangerous in a good way. Imagine that you promised to buy a 10th ounce coin for $530 a month, which is perfectly reasonable and feasible, basically the amount you spend on dinner and drinks each month. 10 months later, you have an entire ounce of gold without having to save for a year or worry about market timing. You just keep buying from month to month. Here is what no one talks about. When you do this, if gold prices rise, your previous purchases are now more valuable, but if gold prices fall, your future purchases will be cheaper. You don't even try to average the cost of the dollar into an important gold position. This is a big advantage, and when you think about its psychology, it is actually great. I need to be honest here, because this is where fraction gold gets a bad reputation, which most financial commentators misunderstand. The premium per ounce for fraction coins is higher than for full ounce coins, which we mean 8 to 12% for 1/10 ounce coins and 4 to 6% for 1 ounce coins. Why did this happen until someone told you it was a conspiracy? It is just basic math. The cost of producing an ounce of American Golden Eagle at a US mint is roughly the same as producing a 1/10 ounce coin. The same mold, the same quality control, the same packaging, the same safe transportation, the same treatment in the whole process. But that 10th ounce of coin contains a tenth of gold. So when you make an ounce of coin, these production costs are spread over 10 ounces. But when you make piecemeal coins, they are concentrated on only 1/10 of an ounce. When dealing with smaller coins, the premium is much higher not to drive up prices, but to figure out how the numbers work. Does that mean fractions are a bad way to buy? No, absolutely not, but you do need to understand why you pay. Let me take a closer look at what is covered. The first is minting and manufacturing because it takes real money to turn unprocessed gold into finished, precision-processed coins with government guarantees. Coins must pass purity certification to meet precise weight standards and size requirements, and the infrastructure for doing so is not free. Second, distribution and logistics are important, because as coins flow from the mint to authorized distributors, dealers, and you, transportation, insurance, safe handling, and insurance inventory add up to the real dollar. Third, dealers pay management fees, including staff, technology, and compliance costs, which adds another layer of profit when they buy not directly from the mint but from dealers. Fourth, market demand is a variable that changes everything. When demand surges, as it did in 2024 and 2025, the premium expands because dealer inventories are tight and mints cannot expand production fast enough to keep up with demand. In January 2026, when gold broke through $5,000 per ounce for the first time, the premium of some fragmentary coins was temporarily 30, 40, or even 50% higher than normal, because everyone wanted to buy at the same time. You're not blackmailed here. You're paying for convenience, accessibility, and real financial products, and all you need to know is that it is a premium. That is where we distinguish between really smart investors and people who focus only on any trends they hear. Let me give you two scenarios, and you tell me which one describes your real life. Scenario 1, you now have $5,000 on hand, and today you buy an ounce of American Golden Eagle. You have an ounce of gold, which is option A. Scenario 2. You have $500 a month for physical gold allocation, so you buy 10 ounces of coins a month, and 10 months later you have the same ounce of gold, but you pay an additional $400 in the total premium. Under what circumstances are you honest with yourself? Because if you are scenario $15,000 immediately available, the coin counting argument will become weaker. and you should buy only whole ounces and accept a slightly lower premium because you are playing an efficiency game per ounce, and coin counting will lose. But if you are scenario 2, if you are an ordinary person trying to build gold positions over time without disrupting your monthly budget, bits and pieces of coins are not only worth it, they're necessary. Think of it this way: the premium you pay for scrap is the price of accessibility, the cost of being able to start right away, not waiting 6 months to put together a whole ounce. In the rising market, gold has been rising, and participating in the game 6 months in advance may fully make up for the entire premium difference. If you bought some gold worth $5,300 at a low price in January 2025, and then gold rose from $2,500 an ounce to $4,600 an ounce in April 2026, what is the significance of the $400 premium? Not really. You're just raising prices for a few $1,000s and swallowing the cost entirely. But let me tell you the other side of the story. If you buy point gold at a time when gold is at a record high and you expect to get rich soon, you're playing the wrong game. Gold is not doing fast. Gold is doing patiently, and gold has accumulated wealth for decades. This is a problem that no one can explain very well. In fact, it is one of the best reasons most people miss holding fraction gold completely. Severability means you have the ability to sell small pieces of gold without having to liquidate everything you accumulate. Imagine you own 51-ounce gold coins worth about $25,000. Now imagine an emergency. Your car dies, your roof leaks, your medical bills pass, whatever. You now need $2,000 in cash. What do? You sell an entire 1-ounce coin for $5,000, even though you only need $2,000. Now you are too liquid, raising more money than you need, and then you are out of the market. You turn $2,000 into $5,000. Now imagine you have 50 coins for every 10 ounces, worth the same $25,000, and the same emergency blow. You need $2,000, so you can only sell 4 coins for less than $2,100. The problem is solved immediately. You keep investing, your money stays in the game, and you don't have to make inefficient decisions. Because the denomination is too large. That is what is really interesting. This separability became a huge advantage during the market crisis. In 2020, when the COVID-19 epidemic hit and the market was completely crazy, gold demand soared overnight. Premiums temporarily doubled or tripled. Traders' inventories were completely empty, and people desperately wanted to own gold, but they could not be found anywhere. Do you know who has an advantage in that environment? People with coins, because you can sell a 10-ounce coin to a family member or friend for the asking price without moving an entire ounce. You can raise money with smaller, more efficient stocks, and you can be flexible when everyone else is in trouble. The rich have always understood severability, which is why they own multiple properties rather than a mansion, so they can sell one without selling all of them. That is why they hold different stock positions, rather than all the stocks in a single large cap stock. Separability is optional and free, and fraction gold gives you the same advantage in precious metals. This is noteworthy. Let us narrow down and look at the reality of the global gold market, because that context matters more than most people realize. In 2025, the total global demand for gold reached 5,002 tons, a record high. This is not a typo, but an unprecedented global gold buying, refining, and hoarding. Where did all this come from? Investment demand alone reached 2,175 tons, an increase of 84% over the same period last year. Consider this number: gold investment demand is up 84% a year. This is abnormal, indicating a serious inflow of funds into precious metals. Gold ETF increased by 801 tons in the whole year. Physical strips and coins, real tangible objects worth 1,374 tons and $154 billion. The central bank added another 863 tons because even the government is now hoarding gold. Why is it important for you to sit here and watch this video now? Because that means you are not betting on certain fringe theories or niche assets. You are moving into areas where institutional money, foreign governments, and millions of retail investors are already operating. The World Gold Council estimates that in January 2026 alone, gold broke through $5,000 an ounce for the first time in history. Not because of some crypto bubbles or retail FOMO, but because of high economic uncertainty and rising geopolitical risks, real money flows into gold as a safe haven. What is important about fractions in this environment is that they are actually the perfect vehicle for the next wave of demand. Because if demand for gold continues to grow and the data show growth, it will not be driven by institutional investors buying 400 ounces of gold bars. They will be ordinary people like you, methodically building positions, starting with a 10th ounce of coins and eventually creating a large number of long-term holdings through score accumulation. This is a story that no one has yet talked about. If I dishonestly criticize Score Gold because it has real limitations you need to understand, I will oppose you. First of all, the cost per ounce is indeed higher, which is not negotiable, and you spend more per ounce on small coins than an ounce of coins. If you're a big totalizer with a lot of money available, buy whole ounces and whole bars, because fraction coins are retail products designed for retail investors. Second, smaller coins are more easily lost, about the size of a 10-ounce dime. So if you are disorganized or careless, they can disappear into the thin air. You need to store your capsules, boxes, or home safe. Not just throw them in a drawer and hope they refine. Third, the resale spread is greater. That is, when you sell a 10th ounce of coins to a trader, the percentage of the bid-ask spread is greater than when you sell a whole ounce of coins, and you recover a smaller premium in the resale process. Fourth, gold does not generate income. It needs to be understood that gold does not pay dividends, does not generate interest, does not generate rent, and your return comes entirely from the appreciation of prices over time. If you need cash flow, gold is a hedge and a store of value. This is not an investment in earnings, so don't think of it as an investment. So who should really buy Score Gold and who should skip it? If your monthly availability is limited, say $500 to $2,000 a month, if you want to convert average costs into gold, if you want to be flexible in raising money in an emergency without selling everything, if you are willing to pay a premium for accessibility, buy fraction gold. If you now have $50,000 or more to allocate, you want maximum efficiency. If you are not organized to store them properly, if you are trying to get rich fast, or if you don't actually believe gold is a long-term store of value, skip some of them. Honestly, tell yourself which camp you're actually in. After looking at all the data, all the market trends, all the real scenarios, I think fraction coin is not a hoax or conspiracy. If your situation is in line with their actual design, it must not be suboptimal. When you don't have $5,000 on hand now, they are legal financial instruments to build gold positions. Did you pay an ounce more? Yes. Is this excess worth the convenience and flexibility? The answer depends on your situation. I think it makes sense for ordinary people trying to hedge against inflation, diversify into the stock market, and accumulate real wealth over the next decade. The real question you need to ask yourself is simple: do I really want to start? Because the worst, absolutely worst thing is to watch gold rise from $2,000 an ounce to $10,000 over the next 5 years while you sit there waiting for the perfect moment, the perfect price, the perfect everything. Waiting is a decision, usually a bad one. If you can start buying scraps of gold coins immediately this month and promise to accumulate them over the next 35 or 10 years, you will make better decisions than 99% of bystanders. That is the whole analysis. The real question is whether you really want to do something with this information or watch 20 more golden videos with your purchasing power destroyed. Thanks for watching, and if you really want to amass wealth, click the subscribe button. If you already own gold, please tell me in the comments how much you actually buy now. See you next time.